Everyone, welcome back to Canopy's Fireside Chat series. I am extremely excited to be having this conversation today with a longtime friend, colleague, mentor of mine, my friend Greg, who's joining me on the call right now. Greg, why don't you introduce yourself?
Sure. Thanks, Matt. It's great to be here. Hi, everyone. Greg Lisiewski, uh, lifelong fintech nerd. Been doing the credit thing now for longer than I want to admit, but 20 plus years. A mix of big co, some banking, and some early stage startup. Excited to chat with you today.
Amazing. And it would be important for me to highlight that one of the key reasons of us having this conversation is I am incredibly excited to be welcoming you to the Canopy board. So Greg is joining our board and is bringing his wealth of experience, his war stories, all of the ups and downs of the past couple of decades in fintech and lending to our team, which is really, really exciting.
Yeah, Matt, thanks for that. Really excited to partner with you and the team and the board to help Canopy achieve sort of its full potential on growth. Hopefully as much as the stories bring some lessons to bear as well.
They do say the biggest scars tell the best stories, and I'm sure you have several of them. Let's kind of go back down memory lane a little bit. You started off your career at MBNA, which was one of the premium affinity card programs in the country, which also happens to be right in our neck of the woods here in Maryland, which is pretty cool. I'd love for you just to share a little bit about starting off your career. What were some of the things that you learned that are still true today? And what are some of the things that have changed or evolved over time? Thinking back to those early days at MBNA.
Yeah, MBNA in the mid 90s was a pretty special place. And the thing that has stuck with me my entire career was our obsession at MBNA with the customer. I mean, over the top obsession. Just a couple of anecdotes. Every doorway had think of yourself as a customer above it, both sides. Every table in the company was round, whether it was a two top or an 80-person United Nations style made of wedges of wood um, table. And the symbolism was no one sits at the head of the table inside the company. The customer was in charge. Everyone's badge outside their desk said customer advocate, not your title. Um, Everyone did call center work, regardless of whether or not you were a call center person or an engineer or a product person like myself. Just a real obsession with the customer has carried me through my entire career.
That's really amazing, and I think that we talk a lot here at Canopy of the products that you build, whether it's in fintech or some other industry. You have to facilitate a better life experience, and to me, that's what the best products do. They facilitate a better life experience, and that experience is the end user. And so, I think that is really true, and obviously I think it's one of the main mantras of fintech in general, right? And that's something that has separated out fintech maybe from traditional banking is putting that customer first. So with MBNA, what were some of the things that you all got right early on, and what were some of the things that maybe the timing was a little bit off?
Yeah, it's a great question. So our obsession with the customer part we got right, and yeah, I can remember being there, in my mid 20s in the late 90s, and at the time it seemed like we were tragically late to the internet. And I would say in general, we were slow to adopt new technology or new experiences. For those of you not keeping track of the card markets in the late 90s, in Little Delaware, Wilmington, Delaware, there was MBNA on one side, and a mile, which is the other side away, was a company called First USA, and they had done a $1 billion deal with AOL in I don't know 2000 or something like that. And I was like, oh my gosh, we're going to lose the internet. Uh, Obviously, that wasn't the case given how early that was in the space. But I think just in general, we didn't embrace technology fast enough, and we sort of we became obsessed with. We had one of the highest performing stocks of the '90s, And it was fueled by this, I don't know how many quarters it was, 20 consecutive quarters of 25% quarter over quarter, year over year growth. And unfortunately, that becomes really hard to sustain. And and rather than sort of backing off to 15% growth and diversifying product, and I'm a product centric person, I think that's ultimately why we sort of had to sell to Bank of America. And that was a great exit and whatnot. But I think MBNA could have become the American Express of the coming out of the 90s from a brand perspective if we had just sort of been a little faster on technology and candidly sort of moderated our aspirations on year over year growth because we ended up when you have to hit the number, you come up with really creative ways to do it, but they're not for the benefit of long term, and we ultimately paid the price for that.
Wilmington, Delaware is a pretty interesting town. What do you think made that so special for the card space? I mean, there were all of the premier players had their headquarters there.
Yeah, and many still do. It really traces its roots to the exportation of usury rates. It all has to do with sort of friendly state laws for corporations. It may not be the largest. I think it is the largest state for corporations, although they're being challenged by some other states and some decisions made. But in general, at that time period, a lot of the credit card banks established that as their host state because the exportation laws were friendly in terms of usury caps and whatnot. Which
Super
is
interesting.
odd, right? Like this Mid-Atlantic credit sort of
Yeah.
thing, and it's a small town, but it's between New York and DC. It's fairly well situated, easy to get to on the train, 20 minutes from the Philadelphia airport.
So let's fast forward a little bit. You wound up being one of the first team members of a company called Bill Me Later, which I think is the first the OG in the buy now pay later space. That they didn't call it BNPL back then, but that was a completely brand new concept of a product at the time. And so I'd love to just kind of hear about finding a market and building a product as really one of the first to do it, and what it was like to understand demand and some of the ups and downs of figuring out that product fit for something that was really brand new in finance.
Yeah, I mean, you touched on it earlier about fintech sort of looking to improve experience, and Bill Me Later hit on a couple of things at that that really tapped into newer things at the time. I joined as the head of product in 2006. Bill Me Later had a little bit of traction, but we hadn't hit hypergrowth just yet. And there were really three things, I guess, that were unique to Bill Me Later. One was leveraging merchants for distribution. So the distribution model was based on merchants helping sell more goods, right? Online merchants specifically. So that was first and foremost was like, hey, online retailer. And we had all the biggest, Walmart, Amazon, Best Buy, Zappos, Overstock. It was you can sell more goods if you make financing available to customers earlier in the shopping journey. Um, and then second was giving consumers that real-time access that happened offline forever in a physical world, whether you're going similar stores, Best Buy or Home Depot or a mattress store or furniture store, et cetera. But we integrated it into
But
checkout.
it was layaway, right? I mean, I used to grow up
Yeah,
at going to Kmart and putting
yeah,
things on layaway. So
yeah.
yeah.
You go to the back window, right, and get your 5 payments of whatever. And um, customers need payment flexibility and affordability and whatnot. So we meet them at the point of need. And then what we did different than credit card companies in 2005, 2006, and not as so much today, but at the time, we used to call it we used to call it instant decisioning, but it was really instant maybe. It was uh, if you applied, we knew who to say no to, but we weren't quite sure we wanted to say yes. So if we were yes, we'd say maybe, and then we'd run it through analog processes. And even if were saying yes, you still had to wait 3 weeks to get your card. Bill Me Later, Bill Me Later turned that into two pieces of information, top of mind information for the application, quote unquote application that was built in the checkout. And not only did we say yes instantly, we provisioned instantly, right? So you went from a $250 cart at HP.com to 6 months 0%, only with two additional pieces of information to your checkout, which is date of birth and last four of SSN, and then you had credit. Like that was it. You were through the purchase and you paid for it later. Yeah, which you see all over the place now with the rise of modern buy now pay later. But in 2006, 2007, 2008, this was not happening. It was really, really special time.
And can you touch a little bit about, when you think about today with a firm's model versus Afterpay's model versus Klarna's model, how do you think about utilizing the funds in someone's account, so a more debit card based layaway product versus a line of credit where you're actually taking on risk as a company and putting it a little bit more into the credit card space. So, what were some of the things you all had to think about from a risk standpoint, from a liquidity standpoint, in terms of what you're underwriting for? Do you have to look at someone's bank account? Are you looking at some of the other risk-based pricing that we know today? Back then, smaller access to data and APIs. So, how did you think about risk when you're going through the approval process, knowing that you're trying to make it simple and easy for the customer?
We learned pretty early that there were really two different underwriting activities happening online. The first was identity underwriting. And you can imagine in 2006, um, there weren't a lot of tools to help you with this, right? There are now dozens of service providers that will help you verify identity online. So we had to create all those models um, from scratch, and you have to train those models the hard way by getting the scars and the scrapes and making the bad decisions. Um, and shout out to those early teams. In fact, one of them became the co-founder of Sardine, one of the premier providers in that space, Zahid. So yeah, we were doing a lot of stuff around that IP address, distance to purchase, delivery. We were just creating complicated models to make sure when we had data that said it was Matt, that it was really from Matt. Um, and that's sort of a discrete step. It's like, do I believe that the person saying they're Matt Bivons is Matt? It's like, okay, I do. Then becomes the traditional question of like, how much money, if any, am I willing to lend to Matt? And there the key for us was getting all of the data we would have used in our bank days to make a decision without having to overburden an application form. So we had some really unique partnerships with the bureaus and others to be able to pull the data and do a match with data that it wasn't as complete as banks might get. Only the last four of a social security number, only a name, address, and an email address. But we managed to do it. And then once we had the bureau, we did actually pretty traditional underwriting. Um, from a credit risk perspective, but there was a lot of innovation on the identity side and being able to get bureau data without sort of a full quote unquote full application.
And speaking of the bureaus and just and how that goes with underwriting, today I think a lot of the largest BNPL companies actually provide this kind of ghost line of credit in the background, even though you might be financing individual purchases. It all is based on a single draw from a larger line of credit that you're underwritten for. Back then, how did you think about, well, if we have 10 micro loans, these are 10 different bureau reports that have to be sent. And I think even today, people are still trying to deal with how do you report on these smaller versus larger purchases that might happen at a higher frequency.
Yeah, the bureaus are still figuring out, the industry is still figuring out the right way to handle, $100 and four purchases, relative to a $3,000 Peloton purchase, relative to a
Right.
revolving line of credit. Bill Me Later um, operated in two different ways when I was there. One, we called it transactional credit. So we didn't tell you how much you had to spend. If you made a $500 purchase and we approved it, that's what you had. And the next purchase, you weren't sure if it was going to be approved or declined. However, it was always sitting on top of a revolving instrument. So we did in fact have a shadow line behind the scenes that we didn't communicate, et cetera. And it sort of dovetails with the last answer. The reason we started there was to actually manage our exposure. So if we got it wrong on the credit decision on you're buying a $500 computer from HP, um, we could figure that out via first payment default or whatnot, and that we limited our exposure because once we told you we would lend you $4,000, the bads tend to go bad quickly, and we'll take you for $4,000. So that's how we manage. That transactional credit phase helped us manage risk, and the bureaus for us were simple because it was a single revolving line of credit. Um, more closed-end loan, buy now, pay later. It's become complicated on the bureau side, and the industry is still kind of sorting it out. Um, Interestingly enough, I ran consumer product at Bill Me Later. Transactional credit is great to manage risk, but back to like customer obsession, it's not great for the customer. Like it's it because they don't like surprise when they go to use a credit product. So I championed for a long time. We just tell them how much we're willing to lend them, and eventually,
Well,
and eventually we
just to
did.
touch on that, point there, I think it is still bonkers that the largest credit card companies today, if you apply for a new card, you have no idea what you're going to be given. It's a complete unknown, whether it's
Yeah,
a $10,000 line, a $20,000 line, a $1,000 line, and then you're getting a pull on your credit, and you may actually not get the line that you need to do the things that you need to do. And so that
yeah,
that transparency still exists today,
yeah. That
or
gap is still there.
lack of
I mean,
transparency.
yeah, exactly. Yeah, no, for sure. There's some new moves towards pre-qual flows, which give you a sort of price. You don't know price either, right? Like it might be this, it might be that. So there are some more progressive companies that are saying, "Hey, we're going to lend you $20,000 at 19.5. Like, do you want it or not?" But that's not the prevalent. Totally agree. Yeah, we used to have a joke at Bill Me Later that if you wanted to go on a trip, you better book the airline ticket first because we tended to base your shadow line on your first purchase. So if you were one of our airline partners and bought an airline ticket, we'd approve you for 6 months for $1,000 ticket. Great use case, travel, big ticket delayed consumption, we called it. And then if you went to Amazon and bought a book, no problem. But if you bought the book first, uh, we might give you a $200 shadow line and you get about $1,000 airline ticket. We would decline you for that second purchase. Some of our early models, we were blazing trails here, but that sort of mattered. I'm happy to say now we just communicate. The product still exists under a different brand, PayPal Credit, and it's a little different these days. But those were good times. I mean, we were truly sort of pioneering new ground.
Yeah, and obviously it caught traction and notice of PayPal. You mentioned them. It was a really big, successful acquisition to PayPal, which started your first of two different tours of duty at PayPal, which I'd love to touch on in a moment. But fast forwarding a little bit to you founding your first startup, would love to kind of hear about the insight that you had to start BlissPay and why it was right for that time as the next evolution of BNPL and cards.
Yeah, sure. I had it's a lifetime ago. PayPal acquired Bill Me Later in 2008. Yeah, three days I think it was before Lehman Brothers collapsed. So we were a billion-dollar credit business exit while the credit markets were melting down around us. Um, which is a whole different fireside chat on its own.
Uh,
Uh,
you
s-
timed the market perfectly. I'm sure that was all planned. Yeah.
yeah, well, 6 months earlier we were prepping for IPO roadshow, so the markets it all worked out, but you never know how the universe is going to play out. So I stayed for 5 years, and the markets were capital was tight, 2008, 2009, 2010, on all dimensions, particularly for lending businesses. So uh, come 2014, which is when I founded BlissPay, a couple of things had become true. One, venture capital and debt was returning to consumer markets. There were a lot of B2B businesses stood up in that time frame. Um, Lending Club on deck, those types of businesses. But consumer revolve a little less so. And uh, the second thing that was true is PayPal had taken the Bill Me Later business, and it became a real 5 years later. It was a very big product line for PayPal and continues to be to this day. However, um, we kind of I'm trying to use words carefully here because I don't want to offend anyone. So we kind of left the merchant side of the business open, right? Bill Me Later as a category, Bill Me Later, Buy Now Pay Later as a category is a B2B to C business model, or it had been until the current wave we're in, which means we distribute it through partners. Well, PayPal had a wallet and it already had yellow button distribution. So it focused on distributing the credit product through its checkout button and left essentially the merchant side open. And I saw that, and Max saw that at a firm, and uh, Sebastian and Klarna eventually got around to that, and Nick and the Afterpay crew, and Josh Abramowitz and Brad. Those are sort of the five of us who were there in 14, 15, 16. They either saw that insight or saw it as an opportunity, not knowing that PayPal had sort of walked away from it. And I had an itch to go early stage after the Bill Me Later experience. So in cooperation with the people I worked for at PayPal at the time, decided to step out and take a crack at building. It was similar, but not identically similar, same product as Bill Me Later, using things I sort of knew uniquely about the market, which was merchant distribution was important. There was great consumer demand for widespread accessibility to financing. So, Bill Me Later built its own network of merchants. PayPal has its own network of merchants. They're both online. I saw an omni-channel opportunity and consumers who want to use financing everywhere they shop. So we built the product on top of Visa, and launched in 2015. And that was really the key insight. It was making it simple for consumers to take the value prop everywhere they want to shop, while making it easy for consumer or merchants rather to integrate. And by putting it on Visa, I like to say there's only two standards in all payments: Visa and MasterCard, um, and that are truly ubiquitous. And that led us to build our product on top of Visa, which made it easy for merchants because they didn't have to do back office payment integration, and it made it super easy for consumers to understand and use. We started with a digital relationship, but we deliver a physical plastic. Essentially, it's become widespread here in 2025. Right, every buy now pay later provider offers at least a virtual card solution. Happy to say we were doing it in 2015.
So thinking back to that time, 2014, 15, 16, I was at Earnest and SoFi. We're obviously competing pretty heavily in the student loan space, personal loan space. There was a bunch of different early lending companies that got started around that time. A lot, though, that was built was really nice UIs. So a nice front door, nice front end. But behind the scenes, things were still just a complete nightmare, right? And so, can you talk a little bit about some of the plumbing and infrastructure that you had to build and use, and some of the challenges? Obviously, then companies like Canopy exist to make that a little bit easier now, but would love to take a trip back 10 years ago when uh, you had to figure out all of the different components to build a lending product from scratch.
Yeah, it's building off the Bill Me Later experience. The markets still were not that mature in 2015, 2016 on identity, um, on identity side as well. So we had to go through and figure out where to get data from to make sure we wanted to how to verify identity. Um, and then it really came down to what platform we were going to build and manage this relationship on. And this is why one of the reasons I am really excited about Canopy, because there wasn't a Canopy in 2015 to partner with, nor were there really other alternatives. If you wanted to issue a credit card, first of all, there were no real venture backed credit cards in the space. Um, Banks weren't familiar with it. The bank partners weren't familiar with doing credit cards. Um, you had really big incumbents, First Data, TSYS. Um, they really hadn't embraced fintech yet. So we had some early challenges of like finding a bank partner. I must have talked to a dozen. Um, and it was like, hey, we can do installment loans all day long, but we don't do credit cards. And I'm like, well, this it's important for my product to be built on a credit card because I had this unique insight that was really important on the customer and merchant side. Fortunately, we found a great partner. We were partners at First Electronic Bank. We learned how a fintech sponsor bank can launch a credit card together. Um, and we eventually found a platform that was willing to take a shot with a venture-backed startup. It was one of the big players, and they were great. Um, we made it happen, but it was a little harder. And it's fair to say, their technology stack, obviously it would do all the nuts and bolts very well because it did it at scale, but integrating with a startup, in a modern API way, those were kind of foreign words to that. We had to stand up MQ series servers and all sorts of things you wouldn't have expected. And then we were doing things that they were like, we don't think you should do that, like showing the customer a CVV code virtually. I literally can remember the memories fired off here. This will sound insane in 2025, given the rise of virtual cards, but yeah, I can remember saying, "Well, we need a service to return the CVV," and they're like, "Our information security team says we're not allowed. You're not allowed." And I say, "Well, with all due respect, it's my risk, not yours." And by the way, on like page 422 of your paper manual, there's actually a service that returns CVV. You just enable it for us. And they were like, "Oh, there is?" And they're like, "Oh, apparently we built it and never used it." So those are some of the things we went through. They had an event service that we were like, we'd like to subscribe to that. And they were like, "Oh, we're sunsetting that. No one needs to know every interaction that happens on the platform." And I said, "No, no, 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 no. I do. We would like to, because we would like to tell the customer every time they have a transaction that did this, that, or the other thing." Yeah, the idea of a webhook, event-driven webhook infrastructure just was foreign. So, yeah, we managed to pull it all together and had, a great customer experience. On top of, I slept really well on the sort of interest calculation piece of it and the statement production. Um, but we were pushing the partner's technology to limits, or using it in ways it hadn't necessarily been built for. And it's only 10 years ago, right? It's not like it was 50
Yeah,
years
I
ago.
mean, I think transparency, going back to that key word, was not really a thing. I mean, because most of those systems didn't apply any of the interest calculation until the statement was cut. And so giving
That's
people
right.
visibility into it, let alone the unstructured messiness of MCC codes to be able to bucket
Uh,
and group transactions. I mean, I think that's why personal finance apps started to come up around that time. At Earnest, we were one of Plaid's first customers in the finance space. But just trying to look at the other side of the balance sheet and understand, where the spend buckets are going, which I'm sure for you would also be important to influence the merchants that you acquired. But that ability to look at velocity and transaction data in a real time basis just wasn't possible.
yeah, 100% for sure.
So you're at BlissPay. You raise over 30 million from top tier VC firms. Have another successful exit to Alliance Data. So you're on quite a tear between NB&A with Bank of America and Bill Me Later and PayPal and your own BlissPay with Alliance Data. You are now back at your second tour of duty at PayPal. Um, would love to just kind of hear, seeing these different levels of your career from uh, startup that is scaling quickly, all of the war stories of doing it yourself, now going back to a company that, given the day in the market, is north of 75 billion. Would love to just kind of hear about how you operate a fintech product at that scale and some of the things that you feel like it's the right time for the next iteration of fintech.
Yeah, the great thing about uh, the fintech space in general is that it's just a massive market. Like regardless of the product, it's a massive market, and that's true if you're domestic only in the U.S. And it's just exponential if you end up global. And the return to PayPal, just to touch on it quickly. was an opportunity to take all of these learnings, my own startup venture and an exit where, we got off the buy now, pay later wave a little early relative to where it would go. It gave us an opportunity, it gave me an opportunity to work with great people because many folks were still here and take the assets of PayPal, which are world class, um, and sort of win the longer buy now, pay later war. And that was a great phase for me and really proud of what the team accomplished over the last 5 years. But at some point, I'm a builder and product oriented person and just wanted to step out of corporate and rather than going in and building my own thing is find a way to partner with really smart and capable folks and teams in the fintech space because I still think there's way bigger days ahead for fintech than behind us, right? It's a category that's 10 if fintech was not what we called the space Bill later was in 2006. We called it alternative finance, right? Fintech, I think, would come as a term somewhere shortly thereafter, which makes it less than 20 years old. And lending particularly is as old as the earth, I think. It's people have been bartering forever. So I just think there's still so much growth in fintech, and I think to unlock the best customer experiences, you need really great infrastructure, and that's why Matt, I'm excited to partnering and join you all. Is as the infrastructure gets better and more enabling, the products can be faster. On top of it, the solutions for customers can become richer and more personalized and tailored. And particularly at the dawn of AI as we sit, I think that'll only continue to be more true. So that's what I'm looking forward to: is what do the next 20 years look like? Taking um, you taking where the technology's at from an infrastructure servicing layer like Canopy to the agentic things you can do on top of it. I think there's really a whole new world out there to be tapped into and explored and developed.
Uh, well, I very much appreciate the kind words, and obviously we're thrilled to have you on the board and just all the experience that you bring that we talked through today. I think that, at Canopy, we see a similar opportunity on the merchant space, right? Which is where we think B2B lending can be much better. And I think you also touched on the word personalization, which is, we very much believe that a lot of the financial products that exist today are commoditized, right? The user experience might change slightly. People try to get a little bit creative on the alternative data that they use to underwrite, but ultimately the 3-year product is the 3-year product, and the borrower wants something that is more uniquely tailored to them. And so we think a lot about what Marqeta did in 10 years ago to the debit card space, making virtual cards easier, became a self-fulfilling prophecy of course, all of the fintechs spinning up debit cards. We think about doing that over the next decade in the B2B lending space, particularly in the commercial revolving card space. We think there's a huge opportunity there to continue to innovate. Because as you know, the revolving card space, it just has immense, almost limitless complexity to it.
Yeah, no, for sure. It does. And yeah, Plaid's a great story. Marquetta, Jason Gardner, yeah, I know you know him well as well. What a great pivot he made to become the infrastructure for fintech over the last 10 years. And I think you're right. Canopy is well set up to sort of play that same role in a slightly different space. It's going to be exciting.
Amazing. Well, really appreciate the time today. Even more of you again joining the board, and cheers to many more fintech conversations to come. And that's it for this episode, gang. Cheers.